Before you turn 40, there are a few financial decisions that can shape the rest of your life. Not the motivational kind, not the get-rich-quick kind, but the practical, wealth-building kind that quietly determine who enjoys freedom and who ends up working out of fear. The truth is, money isn't just about how much you make. It's about where you put it, how it grows, and whether it protects you when life changes. In this video, we're going to break down 5 essential accounts every financially serious person should have before hitting 40. Accounts that go beyond the usual savings and salary deposits. Accounts that help you invest, diversify, protect your money across borders, build long-term security, and take advantage of opportunities that most people only hear about when it's too late. We'll talk about the CDS account, your entry point into owning shares and bonds. We'll look at the money market account, the quiet income generator that keeps your savings working instead of sitting idle. We'll dive into offshore accounts, not as a luxury, but as a strategy for protecting your wealth globally. We'll break down the importance of a retirement or pension account, because financial independence doesn't start at 65. It starts with planning. And finally, we'll explore mutual funds and high-yield investment accounts where your money grows even while you sleep. 1. CDS account. To invest in any regulated stock or bond market, you first need a CDS account, and many people don't fully understand what that actually means. A CDS account, or a central depository system account, is an electronic account that holds your shares, bonds, and other securities in digital form under your name. Instead of receiving physical certificates, everything you own is recorded and stored securely in a centralized system. Think of it as the investment version of a bank account, but instead of holding cash, it holds assets like equities and government bonds. What does it entail? First, it gives you a legal identity in the financial markets. Every share you buy, every bond you invest in, and every transaction you make is tracked through your CDS number. It ensures proof of ownership, protects you from fraud, and allows regulators to verify your holdings. It also means that you don't have to deal with lost documents, delays in transfers, or disputes over ownership. Everything is electronic, permanent, and transparent. But opening a CDS account is not just about access. It's about timing your investments correctly. Many people assume you buy shares whenever you feel ready or have some spare cash. But that's not how wealth grows. The right entry point makes a clear difference. One of the best times to buy a company's shares is when the company is fundamentally strong, but the market price is temporarily low. Market dips, economic corrections, and short-term volatility often create discounted opportunities. Another strategic entry point is when a solid company announces expansion, consistent dividend growth, or new product lines that indicate long-term value. IPOs also provide access at introductory prices, and rights issues let existing investors buy additional shares at a discount. A CDS account ensures you can act immediately when those windows open. Without it, you simply watch opportunities pass by. Opening the account is the first step, but choosing the right broker is just as important. Your broker acts as the bridge between you and the CDS platform. The best brokers are licensed, transparent, and reliable. You want one with reasonable transaction fees, quick trade execution, customer support, and a platform you're comfortable using, whether that's a trading app, an online dashboard, or a direct advisory service. If you're a beginner, look for a broker that offers guidance or investor education. If you're long-term and passive, choose one with low charges and simple access. If you're active, go for fast execution and market insights. A good broker ensures your investments are processed cleanly, recorded correctly, and easily tracked. Once your CDS account is active and linked to your broker, buying and selling becomes straightforward. You can purchase shares in listed companies, invest in government bonds during public offers, or diversify into ETFs and corporate securities. Every asset appears electronically in your portfolio. When dividends are declared, they're paid to your bank or reinvested. When bonds mature, the principal and interest are credited back to you. When you sell, the securities are removed from your CDS account, and the proceeds are transferred to your linked bank. You don't handle paper or chase signatures. The digital system does the work. The long-term benefits are substantial. A CDS account gives you access to wealth-building tools that most people only hear about but never utilize. It helps you create a transferable portfolio that your dependents can inherit. It allows you to build passive income streams beyond your salary. It gives you a structured way to invest, track, grow, and protect your money over time. You're not relying on luck. You're using a regulated platform built for investors of all levels. To put this into perspective, imagine a 31-year-old named Brian. He's been saving casually in a bank account but wants his money to start working for him. He researches a few licensed brokers, compares fees and support, and chooses one with a user-friendly app and good market reviews. With their help, he opens a CDS account at no cost. In his first month, he buys $200 worth of shares in a stable bank and $300 in a government bond issue. When a market correction hits a year later, he buys additional shares at a lower price instead of panicking. Over the next few years, he adds small amounts whenever he can. By the time he's 38, his portfolio has quietly grown in value. He has earned annual dividends, and his bond is approaching maturity. He never dealt with paper, never worried about ownership disputes, and always had full visibility of his assets. Starting small didn't hold him back. Not having a CDS account would have. 2. Money market account. A lot of people think saving money is enough, but the truth is this. Money that sits still loses value over time. Inflation slowly erodes its purchasing power, and a standard savings account rarely pays enough to keep up. That's where a money market account comes in. It's designed for people who want safety, liquidity, and growth at the same time. It's not as aggressive as the stock market and not as stagnant as a regular savings account. It sits in the middle. Low risk, flexible access, and better earnings than parking money in a bank that pays you almost nothing. A money market account works by pooling funds from many investors and placing that money into short-term, low-risk financial instruments like treasury bills, commercial paper, and government securities. These are assets that mature quickly and are backed by stable institutions or governments. Because of that, money market accounts are considered one of the safest places to hold cash while still earning returns. You don't need to be a high-level investor to use one. Most banks, SACCOs, and licensed investment firms offer money market products where you can enter with small amounts and withdraw when needed. One of the reasons more people are turning to money market accounts is the combination of liquidity and returns. Unlike fixed deposits, your funds are not locked away for long periods. You can access your money with short notice, sometimes within 24 hours, sometimes instantly depending on the provider. That makes it perfect for emergency funds, short-term savings goals, or parking money temporarily while you plan your next financial move. And while the returns aren't explosive like high-risk investments, they are significantly better than what most banks offer on ordinary accounts. In many countries, money market rates range from 7% to 12% annually depending on economic conditions, while normal savings accounts might pay 2%, 1%, or even less. Another advantage is capital preservation. Unlike the stock market, where prices fluctuate daily and losses are possible, money market investments are structured to maintain the value of your principal. You're not aiming for capital gains, you're aiming for steady yield. That makes it an intelligent holding place for people who are saving for something important but still want their money to earn returns in the meantime. You can keep your emergency fund there, stash money between property deals, or grow an education fund without worrying about sudden losses. When you invest in a money market account, your funds are typically managed by professionals who allocate them to short-duration instruments that are stable and regulated. You don't need to understand the details of treasury bills or commercial paper. The structure does that behind the scenes. All you see is your initial amount plus the interest it earns over time. In some cases, returns are credited monthly, in others quarterly, depending on the fund rules. Many people also use money market accounts as a buffer account in their financial strategy. For example, if you're planning to invest in stocks, real estate, or business, you can first place the funds in a money market account while you wait for the right opportunity. That way, your cash continues growing instead of remaining idle. Some investors also deposit large lump sums into money market funds after withdrawing from a fixed investment, then move the money in phases to their new ventures. It acts as both a holding tank and a growth tool. Another big advantage is low barriers to entry. You don't need thousands to start. Some firms allow deposits as low as $50 or $100. And since the money is pooled, you get access to instruments that would normally require large capital if you were investing individually. This allows students, employees, freelancers, or business owners to benefit without needing major savings. When choosing a money market account, you should look at a few key factors. First is the interest rate or yield. Different providers offer different returns. Second is liquidity, meaning how fast you can withdraw your money when needed. Third is minimum deposit requirements, which vary across institutions. Fourth is track record and stability of the provider. Established firms with a clean history give peace of mind. And finally, check if any withdrawal restrictions or charges apply. Some providers allow instant withdrawals. Others have 48-hour notices. While money market accounts are safe, they are not designed for people expecting dramatic returns. They are for people who want their money to grow quietly without daily monitoring. They are perfect for people transitioning between financial stages, building a cash cushion, or protecting part of their capital while investing the rest elsewhere. They are also ideal for disciplined savers who want interest that compounds consistently. A key advantage many people appreciate is that money market returns are predictable. Markets may rise and fall, but interest in a money market account remains relatively stable. So if your goal is to earn steady income while preserving your principal, you get exactly that. Some people even use money market funds as a way to earn passive monthly income, especially retirees, parents, and business owners with fluctuating earnings. Now consider a practical example to make this more real. Imagine a woman named Lydia, 35 years old, who has been saving casually in her regular bank account. She has around $4,000 set aside, but her bank pays less than 2% annually. She learns about money market funds and decides to move $3,000 into one that pays an average of 9% per year. She keeps $1,000 in her normal account for everyday use. Over 12 months, the $3,000 in the money market earns her significantly more than it would have in the bank. When an unexpected expense comes up, she withdraws part of her money within a day and uses it without penalty. The rest continues earning. By age 40, if she keeps reinvesting and adding small amounts over time, she could build a stable cash reserve that grows faster than inflation while remaining accessible at any moment. That's the power of choosing a smarter account instead of letting money sit idle. 3. Offshore accounts. When most people hear the term offshore account, they immediately think of secrecy, the ultra-wealthy, or tax evasion. But that perception is outdated and largely inaccurate. An offshore account is simply a bank or investment account held outside your home country. It's a legal and strategic financial tool used by millions of professionals, business owners, investors, and globally minded individuals who want to protect and diversify their money. You don't need to be a millionaire to open one. You just need awareness, intention, and a reason beyond borders. The first major benefit of an offshore account is currency diversification. When all your money is held in only one currency, especially in a country with inflation, devaluation risks, or political instability, you're exposed. An offshore account lets you spread your wealth across stronger or more stable currencies like the US dollar, euro, pound, or Swiss franc. This becomes a shield against currency shocks, recessions, or sudden government policy changes. It's the same logic used by corporations and foreign investors. Don't stack everything in one economic basket. The second benefit is asset protection. If your country faces legal, political, or financial turbulence, your offshore holdings are not frozen, devalued, or restricted by local controls. This is not about hiding money. It's about preserving access and freedom. For example, if your home country limits international transfers or sets withdrawal caps during a crisis, an offshore account gives you an alternative lifeline. Many citizens in countries that experienced inflation spikes or sudden banking restrictions later regretted not moving part of their funds earlier. Beyond protection, offshore accounts open doors to global investment opportunities. If you only rely on financial systems in your home country, you're limited to whatever banks, brokers, and funds exist there. Offshore banking gives you access to international markets, foreign bonds, multinational stocks, real estate funding platforms, and even private equity opportunities that aren't available locally. You can invest in different regions, industries, and currencies without being tied to one economic climate. Another key advantage is wealth mobility. If you plan to relocate, study abroad, invest internationally, or run a global business, having an offshore account makes transactions easier. You can pay for property in another country, receive international payments, fund a business abroad, or send children to school overseas without constantly converting currency or relying on unstable local systems. This flexibility becomes even more valuable as globalization increases and borders become more fluid in terms of finance. Now, there's also the tax efficiency conversation. Offshore accounts don't automatically remove your tax obligations, but they may offer better tax treatment depending on the country you choose. Some jurisdictions have low or zero taxes on interest, dividends, or capital gains. Others offer relaxed regulations or incentives for foreign investors. It's not about avoiding your domestic tax responsibilities. It's about legally positioning part of your income or investments in regions where returns are maximized, losses are minimized, and reporting is structured. Choosing the right jurisdiction matters. Popular offshore locations include Mauritius, the UAE, Singapore, Switzerland, Luxembourg, Cyprus, Seychelles, and certain Caribbean financial hubs. The right choice depends on your goals. Some locations are known for investor access, others for tax benefits, confidentiality, currency strength, or business-friendly laws. You would ideally look into regulatory strength, political stability, exchange control policies, and account opening requirements before choosing. To open an offshore account, you typically need identification documents like a passport, proof of residence, and sometimes income or business details. Many institutions allow remote account opening, while some require an in-person visit. The process is not as restrictive as people think, especially if you choose established international banks or digital offshore platforms. Minimum deposits vary. Some require a few $100s, others require several thousand, so there's room for different budgets. Security is another reason offshore banking appeals to people. These accounts are often held in countries with stronger banking regulations or higher financial privacy laws than the customer's home country. In unstable domestic economies, an offshore account is not a luxury, it's a survival strategy. And because funds can be held in multiple currencies, even if one region faces a downturn, your wealth isn't trapped. Offshore accounts are also useful for entrepreneurs and freelancers working with international clients. Instead of receiving global payments through expensive and slow remittance channels, you can use your offshore account to collect income directly in foreign currency, save on conversion losses, and then move money strategically. To put this into real context, Imagine a man named Kelvin, 37 years old, who works remotely and gets paid by clients in Europe and North America. Until recently, he received everything through his local account, losing money to exchange fees and unpredictable currency shifts. He decides to open an offshore account in Mauritius, which allows him to hold funds in dollars and euros. He keeps part of his income there and only converts money to his local currency when rates are favorable. When his home country experiences currency depreciation and inflation hits hard, his offshore savings remain stable. By the time he turns 40, he's not scrambling to protect his money. He's already diversified it across borders and currencies. His offshore account didn't make him rich overnight, but it ensured he wouldn't be poor by surprise. 4. Retirement and pension accounts. One of the biggest financial mistakes people make is assuming retirement planning starts at 50. By the time most people begin thinking seriously about life after work, they've already lost decades of potential growth. A retirement or pension account is not something you open when you're almost done working. It's something you set up early so that money has time to compound and multiply beyond what your salary alone can ever achieve. Whether it's a government pension scheme, employer-sponsored plan, provident fund, retirement benefit scheme, personal pension plan, IRA, or retirement savings account, the goal is the same: long-term security and financial independence. A retirement or pension account works differently from a basic savings account. The money you put into it isn't meant for short-term withdrawals. It's structured to grow over many years, often with tax advantages, compound interest, and consistent contributions. The earlier you start, the less you need to contribute to reach a comfortable retirement income. Someone who begins at 25 or 30 has time on their side. Someone who waits until 45 must contribute far more aggressively just to catch up. And those who don't plan at all often end up working out of necessity, not choice. There are two main types of retirement accounts: employer-based and individual-based. In employer-based plans, a company may contribute a percentage of your salary to a retirement fund, sometimes matching your contributions. This is essentially free money added to your long-term savings. Individual-based accounts are set up personally through pension providers, insurance companies, or regulated financial institutions. These are ideal for entrepreneurs, freelancers, consultants, and anyone whose employer does not provide a structured retirement plan. One key advantage of retirement accounts is tax efficiency. In many countries, contributions to a pension fund are tax deductible or tax deferred. That means you reduce your taxable income while securing your future. The funds inside the account then grow without being taxed annually, and in some structures, only withdrawals are taxed later, often at lower rates since your income in retirement is usually lower than your income during your career. These tax incentives are designed to encourage long-term saving, and people who don't take advantage of them leave money on the table. Another major benefit is compound growth. When your contributions sit in a retirement account, the returns you earn are reinvested and start generating additional returns. Over decades, this effect becomes powerful. A small amount, set aside consistently, can turn into a substantial retirement pool. The person who invests $200 a month starting at 30 will often outgrow the person who invests $500 a month starting at 45. Compound interest rewards time, not urgency. Many retirement and pension accounts allow investments in different asset classes: government securities, bonds, real estate funds, mutual funds, or equities under regulated management. This diversification means your money continues working without exposing you to reckless risk. Pension funds are managed by professionals who balance stability and growth, which gives you an advantage over informal saving habits that rely purely on discipline and luck. A retirement account is more than just numbers. It represents freedom. It gives you the ability to retire when you want, not when your health collapses or your employer decides you're replaceable. Without a pension strategy, many people are forced to depend on children, relatives, or part-time jobs in old age. With the right account in place, you build self-sufficiency and dignity. Even if you plan to work until you're older, having a pension lets you choose the kind of work you do: consulting, part-time roles, passion projects, instead of accepting anything out of desperation. In addition, retirement accounts create financial continuity for your family. Depending on the structure, benefits can be passed to spouses or heirs. Some pension schemes pay lump sums at retirement. Others provide monthly payouts, and some do both. This means you don't just retire. You create a structured income system for life after employment. Even if your income fluctuates or isn't huge, consistency matters more than size. A freelancer who contributes smaller amounts over time can accumulate more than a high earner who delays for years. And if your employer already has a pension system, contributing to it is one of the smartest and easiest ways to build long-term wealth without changing your lifestyle drastically. To put this in perspective, imagine a 34-year-old named Sharon. She works in a mid-level corporate role, and her employer offers a pension scheme where they match 5% of her salary if she contributes the same. For years, she ignored it, assuming she'd worry about retirement later. After realizing how much money she was forfeiting, she signs up and starts contributing. At the same time, she opens a personal pension account where she deposits an additional amount every month. even if it's not much. By age 40, her employer contributions and compounded growth have already created a foundation she wouldn't have built alone. 10 years later, that fund has doubled again. By retirement, she doesn't have to scramble, downsize aggressively, or depend on anyone. What changed her future wasn't luck. It was starting early enough and letting time work with her instead of against her. 5. Mutual fund and high-yield investment accounts. Not everyone has the time, knowledge, or confidence to research individual stocks, track markets daily, or manage a complex investment portfolio. That's where mutual fund and high-yield investment accounts come in. These accounts give you access to professionally managed portfolios that pool money from many investors and spread it across different assets like equities, bonds, real estate funds, treasury bills, and money market instruments. Instead of guessing which company to invest in or fearing the risk of losing everything in a single stock, you ride on a diversified strategy designed to grow steadily over time. A mutual fund account is essentially a bridge between passive savings and active investing. It lets you grow your wealth without personally handling the technical side of the markets. The fund manager or investment firm buys and manages assets on your behalf while you track your returns. This means you benefit from expertise, diversification, and lower risk compared to stock picking on your own. Mutual funds are regulated, structured, and categorized by risk level and objective. Some focus on growth, others on income, others on capital preservation, and some combine these goals. High-yield investment accounts go a step further. These accounts are tied to instruments or funds that return more than your regular savings or fixed deposit rates. That includes bond funds, index funds, balanced funds, and actively managed equity funds with higher return potential. The goal is not reckless risk, but optimized reward. These funds allow investors to access markets that would normally require high capital, deep research, or institutional access. With as little as $50 or $100 per month, you can be invested in assets that would require thousands if you tried to buy them directly. One of the biggest strengths of mutual funds and high-yield accounts is diversification. When you invest in a fund, your money is split across multiple companies, sectors, and asset types. That means if one asset underperforms, others balance it out. Diversification reduces the impact of market volatility and lowers the chances of large losses. It also gives you exposure to asset classes you might not access alone, like government bonds, real estate investment trusts, or overseas markets. Another major benefit is accessibility. Unlike real estate, which may require large capital, mutual funds let you start small and grow gradually. Unlike trading stocks, you don't need to analyze price charts or watch for entry points every week. Unlike fixed deposits, you're not locked in with low interest. And unlike leaving money in a current account, you're not watching it lose value quietly to inflation. The fund structure does the heavy lifting while you focus on consistency. Returns vary depending on the type of fund and market conditions. Income funds and bond funds offer steady yields with lower risk. Equity funds offer higher potential returns, but with more fluctuation. Balanced or hybrid funds combine the two to give growth with some cushion. Index funds mirror the performance of an entire market index, like the S&P 500 or a national exchange, making them cheaper and more predictable. Actively managed funds aim to outperform the market by selecting high potential assets, though they may come with slightly higher fees. Speaking of fees, when choosing a mutual fund or high-yield investment account, you need to pay attention to management fees, entry charges, and withdrawal rules. Reputable funds will disclose all fees clearly. Lower fees mean more of your returns stay with you. But even with fees, the net returns are often far better than parking money in low-interest accounts. These accounts are also ideal for goal-based investing. You can use them to grow money for a home deposit, business expansion, education, or long-term wealth building. Because you can automate contributions monthly, they encourage discipline. Some funds even allow dividend reinvestment, where returns are added back to your capital to boost compounding. Another advantage is that mutual fund accounts can be held individually or jointly, and in some cases, passed down to beneficiaries. This makes them excellent for legacy planning. They also give you liquidity. Unlike retirement accounts, you can usually withdraw your money when needed, though long-term holding is what truly maximizes returns. Risk exists, but it's managed intelligently. Unlike speculative trading, where one mistake can wipe out your capital, mutual funds spread the risk. And because fund managers monitor performance and rebalance portfolios regularly, you're not exposed to unmanaged downturns. To illustrate how accessible this can be, imagine James, age 36. He's been putting most of his money into a savings account and a money market fund, but wants long-term growth. He opens a mutual fund account and chooses a balanced fund that splits investments between bonds and equities. He starts with $100 monthly contributions. Within the first year, he sees modest but consistent growth. And when the market dips the following year, the bond component protects part of his gains. By 40, his contributions plus compounded returns create a portfolio he would never have assembled on his own. He didn't need to study markets, time entries, or pick stocks. He just needed the right account. Mutual fund and high yield investment accounts are powerful because they let ordinary people access the same markets as high net worth investors without needing the expertise or the capital. They fill the gap between saving and wealth creation. They let your money grow while you're busy working, raising a family, or building your career. And over time, they build financial stability that cash savings alone can never match. If there's one principle to take away, it's this. Money sitting still declines, but money placed in the right investment structure expands. And for anyone who doesn't have the skill, time, or confidence to invest manually, mutual funds and high yield accounts are the smartest doorway into long-term financial growth. If you've listened this far, you're already ahead of most people financially, not because you have everything figured out, but because you're willing to learn, plan, and take action before it's too late. These 5 accounts aren't just financial tools, they're protection, leverage, and opportunity disguised as structure. Thank you for watching and spending your time here. If this content helped you or opened your eyes to something new, don't keep it to yourself. Share it with someone who needs to hear it. And if you'd like more content on building wealth, protecting your money, and making smarter financial moves, make sure you subscribe and turn on notifications.